Good afternoon, good evening, good morning, depending when you watch this. Thanks for joining me for another market update. Today I'm going to be taking you through all things property related. Another rate hike. Is it on the cards? Isn't it? And what are some of those factors determining the Reserve Bank's decision? Um, some good news is that there's a lot of rental resilience and appreciation is up. So if you haven't done so already, click subscribe, join the tribe. Um, Also wanted to do a quick shout out to everybody that has subscribed. Thank you so much. We've gotten to 5,000 subscribers, which is quite crazy. I started this YouTubing like properly when COVID started. I'd always like kind of dabbled before, but when COVID started, I really I got into it a lot because I wasn't doing events as much and I wasn't seeing as many people. So it's quite crazy to think that we've got into 5,000. Thank you for everybody that has subscribed. I have changed my name on my profile. It's called Property Bull. And the reason is twofold. That is a term in the property market. If you're a bull, a bear, or base, it just means what's your outlook and your appetite towards it. So a bull is a positive or an optimistic outlook. A bear is a negative outlook. So property bull is I'm pro property, but also my surname is Bull, Boel, slightly different spelling. But yeah, little play on words there. And I've also got a little tag, Lawrence Bull, at Lawrence Bull. So you just go youtube.com/Lawrence Bull and you get me. So starting with whether there's going to be an interest rate hike or not. I don't want to give you guys what I think. I rather want to give you the data that I've seen and how I think about this data, and then you can make your own assumption as to whether you think the rate hikes are going up or not. The first thing we have to look at when we're looking at this decision is the global macroeconomic factors. So, COVID had a huge impact on inflation, on GDPR, and thus the interest rates. The war on Ukraine, both Russia increasing the price of oil, plus by kind of isolating Ukraine, the grain market and the food market has gone up because there's less supply. So there's a lot of these macroeconomic factors. You're seeing the Fed in the US, the central bank in Europe, the Reserve Bank in South Africa. You see the Bank of England all raising interest rates because everybody's trying to fight the same beast, which is unprecedented levels of inflation. So the big question is the repo rate going up again? Uh, you know, everybody's got their opinions and I think it's going to go to about 10, 10 and a half, so another 0.25 or 50. And then I think the Reserve Bank is going to be quite happy, and then hopefully we'll see inflation tapering off. That's the main indicator, right? Now, the way I got to that decision was firstly looking at the data. Now, this data that you're seeing here is the average of the interest rates in South Africa over the last 12 years. So starting here on the left, you can see in 2012 we had an interest rate of 10%. It then went down substantially to 8.5. That's probably after the global financial crisis in 2008, the property market crumbling. Then we saw some growth towards 10.5 at its peak. That was in 2017. Then this arrow, you obviously see the massive decrease in interest rates because COVID happened. The Reserve Bank had to react. We had to stimulate the economy because GDPR numbers were so low. Not GDPR, sorry, GDP. uh, I do a little bit of IT consulting as well, and GDPR is obviously like the data protection thing. So funny. Then we've seen a recovery from COVID. So if you kind of look at what were the numbers pre-COVID, we were at about 9.75. Where are we today? 9.75. So we're pretty much, the economic output is pretty much the same as what it was pre-pandemic levels. The issue is still the war in Ukraine and the high energy costs. That's what's still driving up inflation. So food is expensive. So a lot of people bought at this time. Interest rates were low. People were excited about the cheap money. A lot of people bought, not anticipating or expecting it to go back up here. That's why I think there's going to be a lot of sellers coming into the market, making it a buyer's market. So I think if you've got some cash and some appetite, this is a good time to get in. A lot of clever people fix their interest rates here, which is something you can do. You can go to the bank and say, I'd like to fix my interest rate at whatever the rate is today. It's too late to do that now because, we're back at 9.75. But for future reference, it's important. And you can see all these dots are when the decisions were made. So here, within a space of basically, let's call it 1 year, there was a slight increase in interest rate. And then you can see here now the Reserve Bank got aggressive. Here's a 75, 75, 75 basis point increase. So where do I get this information from? There's various places that you can. This specific one I got off of the Reserve Bank website. This is showing the inflation story. So that was the interest rate story. The inflation story, they're very interlinked, right? As inflation goes up, as things get more and more expensive, the Reserve Bank has a mandate to tame this inflation, and they do that by raising interest rate. When they need to stimulate the economy, then they lower interest rate to put more debt into the market. So the stats you're seeing here are from the International Monetary Fund, and this is showing you from 1998 to 2025. So I want to try and zoom into those last sort of 10 years because that's the data I have for my interest rate. So if I blow this up, here you can see what the interest rates, what the inflation numbers were over the period from 2010. I've then superimposed the the interest rate numbers on here. And what I'm hoping you see is a like for like trend, right? That one follows the other. So as inflation went down, interest rates went down. As inflation goes up, interest rates go up. Here you can see a trend. It's a little bit behind because obviously interest rates follow inflation, but here you can see the trend. So we're just getting back to what I like to call equilibrium. So my opinion and assumption is that once we hit 10.25, I think that's when the Reserve Bank will then break and then see how inflation starts to pan out. And hopefully inflation comes down, which, by the laws of economics, it should. With that being said, no one's got the crystal ball. No one can tell you what is what. What I would recommend is that you go and do your own research. So go onto the Reserve Bank, look at their MPC statements. The MPC stands for Monetary Policy Committee. And that's essentially the group of guys at the Reserve Bank that decide when to raise interest rates and when not to. So every time a rate change is made, they do a summary. So you can go into the September one. It will talk about the grain shortage because of the war. It'll talk about the energy crisis. It'll talk about a lot of macroeconomic factors. It'll talk about inflation, food inflation, or core inflation, and headline inflation. So go do your own research. Go read these documents to get a sense of how these decisions are made. So that's the interest rate hike debate. If I were you, I would anticipate another 0.25 or 0.5 still this year, and then I think next year it'll calm down. There's some good news and some good statistics from a South African perspective in the property economy, and those are that there's a lot of rental resilience and appreciation or escalations are up, which is awesome. So starting here with the TPN Rental Monitor report, this is Q2's data for this year. And I think the main story in the property market for the last couple of months has been this increase in interest rates. A lot of people bought, when it was 7% interest, and they probably bought negative cash flow investments sold as assets. They bought into the new builds or whatnot, and because the interest rates were so low, the developers and the new build marketers were able to show a very small shortfall. But now with an extra 3.5-4%, a lot of people are starting to get a bit worried. But on the flip side, the good thing is that rental payments are still highest priority for tenants, even though they're facing a lot of strain. Now, this is quite an overwhelming picture. I'm going to try and break it down to you quite slowly. And I'm going to focus on one specific market segment, which is the 3,000 to 7,000 Rand range. So what you're seeing here are 5 different income levels, your LSMs. So your under 3,000 would be on your lowest side of the LSM, and then over 2,000, 25,000, and that's monthly rental that's being paid. So you got your lowest LSM and your highest LSM, and then everything in between. And the reason why I'm going to focus on 3 to 7,000 while trying to explain this chart is because that's the market that I've chosen. It's your lower middle income segment. So you can see 4 different colors, the legend at the bottom, and this is doing a like for like comparable of 4 key indicators as to which one of these markets makes the most sense. Now, what I'm hoping that you get after you've gone through the slide is that you can look at this and say, okay, cool. Well, for my return expectation, I'd like to go for the 12,000 to 25,000 Rand um, market because I'm happy with the returns that it provides. I'm happy with the risk, and that's my area. You've got to start here when you're looking at the property market. You've got to start here and say, which market am I comfortable with? Because each one comes with its own returns, but then risks. The market I go for is very good for cash flow. It's very high yielding, but your delinquency rate is quite a bit higher than other areas where people are sometimes more comfortable. So starting at the top with the, I would say the gray color or the light blue. My vocabulary on color palettes is very limited, so let's just call it like a blue gray. The escalation is telling you how much appreciation is happening in the area, both from a rental but also capital growth perspective. So in my market of interest, that's 2.3%. That's not so great. Now, the way that you can see a little bit more detail behind this is first to look at the rental escalations. And what we've got here are rental escalations by province. So on the bottom, you've got your legend of all the different provinces. On the left, you've got your percentage at which the escalations were happening. Now, just before COVID hit, you can see the numbers there. KZN was at 4.6, Eastern Cape at 4%, Western Cape at 3.5, Gauteng was a bit underperforming at about 2.8. Then COVID hit, boom, everything declined. GDP went down, and thus inflation went down, and thus interest rates go up. But what we've seen is a really nice recovery. Almost all the numbers. I mean, KZN is above where it was at 4.7. Eastern Cape seen growth. Western Cape is higher than it was pre-COVID. So rental escalations are looking good. We've had the recovery. We're now going into an upstream market, which is nice. From a capital appreciation perspective, these are the latest stats from Lightstone. So in terms of areas to watch, and I've been saying this for a while because the data's been saying this for a few months now. Northern Cape, Eastern Cape are definitely your areas where a lot of appreciation is happening. I don't know those areas. I don't have much experience there, so I can't really comment. What I can say is that in Western Cape, 6.28, that's quite interesting. It's a bit higher than it was a couple months back, and I think that's because it's tourist season and there's a lot of foreigners that are investing in Cape Town specifically. And Cape Town's got a lot of potential, but it's also a very expensive place to invest. You're competing with foreign capital. You've got Americans and Germans and these guys earning in dollars that come and spend in rands, and their buying power is extreme. So that's what's pushing. I think the Cape Town market's already overinflated. The rest of Western Cape, maybe not so much. I mean, Stellenbosch has also got quite a lot of stuff going on. And then my area, Gauteng, is at 3.4, which is a bit sad. But when you're looking at cash flow investing, you don't really, appreciation is more like the cherry on top. This I thought was quite interesting. This is again from Lightstone, and it's showing the annual inflation, so the appreciation, capital appreciation, based on area bands. Now, Lightstone uses a different model than TPN. TPN has got those 5 different levels based on the amount of rent that the tenant pays. This is sales. So you've got your luxury market, which is anything above the 1.5 million. Then you've got high, mid, and low value. My focus is mostly the mid value, the 250 to 700 market. And what's quite interesting is look at the low value. The properties under 250 have got the highest appreciation rate, hovering around the 10% mark. And then what's funny for me is there's this misconception that when you invest in like Bryanston or Sandton or Mshlanga, you invest in the nice areas, you're guaranteed appreciation. And the reality is that the data doesn't back that up. Here you can see that there's an alignment between mid value, high value, and luxury in terms of appreciation. Look at how these numbers have basically become one. And I have proof of this. I invested in a nice suburb in Joburg, in Joburg North Fourways, and everyone was telling me it's going to go up in value and it's going to be a great profitable deal. And you're right by the Mall of Africa, which is this new mall that and everybody was hyping it up. And over 10 years, I saw like 2, maybe 3% year-on-year growth. So The reason why it didn't work is because when an area like Four Ways seems attractive, um, developers come in. So what happened is I bought this really nice property and I looked after it like a charm, but there were also hundreds of units being put up all over my little complex. And with so much extra supply, the sellers now had the upper hand. The seller could come to me and say, you know what, I could buy from you, but I mean, there's also 6 different new builds that I'm going to go and view this afternoon. So when you're targeting a nice area, you must also realize that there's other institutions, developers, the growth points of the world that are also coming in and snapping that stuff up. And that's going to have an effect on your seller's buying power. So yeah, interesting. So that's what the escalation portion is for me. I'm happy in my market for 2.3 escalation. Rental, I know that that's where I'm going to get about 4.5, 5, 6% maybe. And then on my appreciation side, that's just cherry on top, right? Now we're looking at the good standing ratio. That's the vacancy rate. That's just the rate at which a segment is empty. So 7.6% of the time in my deals, there's an emptiness because I'm waiting for one tenant to be replaced, or I'm struggling to find a tenant or whatever. And you can see across all segments that it's more or less, between 6.5 and 8%. Then we've got the good standing ratio. So this is where delinquency comes into it. You can see in the under 3,000 category that it's a 68% good standing. So that's your highest risk area. Right, those are the people with income instability and any macroeconomic factors that come in. They're the ones that are usually hardest hit. So that's the highest risk category. Then on the highest income bracket, you've got over 25s, you've got a 77% good standing ratio. So that's the second highest risk area to invest in. And I think I know why. I think it's because people at that level are very dependent on their job. I mean, I think everybody is, but because they're paying a lot for their rent, um, if they lose their job or whatever, they're under pressure. But I also think that you've got a lot of um, attorneys and a lot of people that know their rights that are abusing that to be able to stay in properties for free. And I say that not with any disrespect for any attorney, but merely just some of the stories I've heard from friends and colleagues where they've bought a property and they've got somebody who's staying in there. They're not paying any rent, but they keep attending all the court hearings, and then they'll pay a little bit here, a little bit there, and they play the court's loopholes in order to stay there for long. So funny that that's a high risk segment, and then between your low and middle and high middle, you've got 85% sort of average. So if we go into this one a little bit more in detail, the first thing that I want to note is that the South African tenants prioritize rent. Okay, so what you're seeing here is what is most prioritized in the average South African's credit usage. So first of all, mortgages, bond repayments. So there's a 90% good standing ratio of people in South Africa paying their bonds. The second most important item is rent. So first, people are going to pay the banks. They're going to pay the mortgages. Second, they're going to pay their landlords. And then and then in third, you've got your credit facilities. These are the banks that have their credit cards, or Edgars or Woolworths that give out credit facilities. Then you've got secured debt, unsecured debt, and then short-term credit. Now, obviously, the lower you go down on your good standing, the higher the interest rate because there's heightened risk. But what this says for me as a landlord is that, you know, rental income it's in a good space. We've recovered again from COVID. We're in a good space. We're hitting 80% average, which I think is phenomenal. So that's another good, that's the resilience story that's starting to come out. Here we've got the good standing by rent value. Now it's important that, when you're looking at your 5 categories, what your risk appetite is. And that's what this number is telling you is what's the risk of them not paying. So if we start with the under 3,000, the pink bar, you can see that it's a very volatile market and that currently the good standing ratio is at, under 70%. So here you need to be getting a very good return to justify the risk of only having 70% compliance when it comes to, getting paid rent. So you're going to have to put in a sizable void factor, a sizable eviction budget, or you'll need to maybe look at some sort of rental insurance. Your cash flow has to be phenomenal at that level for you to take the risk. Then we've got the 25,000 and up. The market that I look at, the 3,000 to 7,000, here I've just highlighted a little bit. It's averaging around the 80%. Sometimes it goes over. COVID, it obviously hit down. But your market is very resilient. The tenants in South Africa and the lower income markets, there's a lot of resilience there. Which is good because that's where majority of my focus goes. So I'm glad that it's working out. So that's the good standing ratio. The final one is the rental value segment. Now, rental value segment means the size of the rental market, how much is going towards that LSM. So within the area that I've chosen, 3 to 7,000, 54% of the tenants in South Africa are in that category. That's a good thing. I want to be in an area where there is the bulk of the tenants because that's where the majority of the demand lies. And that's why I don't sit with any empty units. Everything is mostly always fully occupied because there's so many people that need affordable, good quality housing. So these are the two graphs I'm going to take you through. The first one is rental market distribution by value. So here I've highlighted the 3 to 7,000 markets, which you can see totals up at 54%, and that's 35% allocated to the 4,500 to 7,000, and then 19.1% from the 3,000 to the 4,500. So I target the 4,500 to 7,000, 35% of the market. I like that area because those are people that have usually got good credit scores, they've got affordability. So as long as they've got a job and they don't lose it or they don't go into tough, they get a tough break, they mostly pay. The second one is the good standing ratio. So this is the story of the 82% that we spoke about. So 84% is in that 4,500 to 7,000. That's again why I like that market because it's slightly lower risk. Your tenant just is a little bit more resilient and a bit stronger. And it's above your national average, right? National average is 82%, so this category is slightly above. From a Lightstone perspective, there's also been some good news that's recently landed. Good news in property price inflation numbers as South Africans head back to their favorite leisure activities. So there's a little bit of stimulus in the economy. I think the war in Ukraine has really come at a terrible time, and I think that load shedding is also having its impact. But I'm still very, very bullish on South Africa as a good investment market. So much so that I'm raising finance from foreign investors because they also see the value and the returns. So from the Lightstone report, there's two ones that I wanted to look at. Firstly, transfer volumes, just showing you the number of volume or the number of transfers that have happened year on year since 2008. There's a decline in the number of freeholds that are transferring. There's an increase in the number of sectional titles. So there's just more and more demand for sectional title, but there's also been quite an increase in estates. I think secure estates is common ground for most South Africans. So, when you buy a property in a gated community or in a security complex, you're definitely going to have a bit of a value proposition. You're going to sell quite easily. Then we've got transfer value. So that was the number. Now it's the size or the total value of these sales. So freehold is actually increasing. Funny enough, there's less freehold transactions happening, but the total value of those sales is higher and growing, which basically means that it's appreciating more than your sectional title. Your sectional title, it's pretty linear. Again, estates are seeing a bit better performance. This is quite an interesting one, showing you the transfer values per price brand. So you can see mid value is the biggest chunk of the market. Sometimes high value, kind of threatens a bit. Like in 2021, a lot of high value properties were sold, and I think that was because of COVID, people relocating, moving to the coastal towns or to the more remote areas, and spending a bit more on a bigger house. So for me, I've always wanted to be in the lower income market because I see that's where the bulk of the activity is happening. Yeah. So I hope that you enjoyed that quick update. In summary, we're looking at rental resilience, we're looking at good appreciation numbers. Are we going to see another interest rate hike? I think it's better to prepare for it than to be kept with your pants down. Please don't forget to subscribe and also check out my market updates playlist. This is where this video will be stored. And every month to 2 months, whenever some interesting news lands onto my desk from either TPN, Lightstone, or maybe the Reserve Bank gives another update, I create one of these videos. So go check it out. Thanks again. To get to 5,000 was an amazing journey. And until next time, happy investing.